David, let's get started with you and hear a little bit more about your role at the CMHC.
Yeah, no, hey, great. Thanks, Stefanie. Great to be here today. We're obviously super excited to be part of the Bloomberg conference again. Obviously, huge thank you to National Bank, who's a longtime sponsor of this. I think it's a great event, and the Bloomberg team do an amazing job. So I guess first off, just a huge thank you. Myself. So Treasurer CMHC. I've been with the organization since 2009. Obviously, a big mandate. We're obviously the housing agency for Canada, so we touch on a lot of obviously a lot of different touch points with housing. Specifically with my Treasury role. One of my team's big responsibilities is the syndication and marketing of the Canada Mortgage Bond Program, also known as CMBs, or as the Bloomberg ticker, CanHouse. This is for folks that don't know. This is a AAA explicit guarantee program of the Government of Canada in its 21st year of operation. So I believe we're officially considered a mature program now. So we've obviously been through a couple of difficult markets over the years, but program continues to run quite smoothly, and looking forward to providing a bit of an update today. So thanks, Stefanie.
Fantastic. We're looking forward to hearing more about it. But before we do, Attila, let's hear a little bit more about your role at the World Bank.
Yes, definitely. And let me echo Dave's word. Thank you very much for having me. And thank you very much for organizing this event. I think this is very interesting and very useful, especially now when the market volatility is extremely high. And we are living through a period of time which we haven't seen in more than 40 years. So not too many, we just discussed with Dave, not too many of market participants actually saw similar events, what we're seeing now. Anyhow, so my name is Attila Juhasz. I'm a fixed income portfolio manager at the Treasury of the World Bank. I'm leading the US fixed income team. Essentially, we are managing assets for our clients, versus Treasury benchmarks. We are quite active. We are focusing on the high-grade universe. And again, here, let me take the opportunity as well to thank NBC for their support in providing us help in finding assets and managing our portfolios. Now, one thing, if you're talking about the history here, IBRD has been created in 1944. So it's a very seasoned institution from this perspective, and it's always been a very innovative institution. I am proud to say, if you haven't heard it or you haven't known that, IBRD was the first one which created the swap market in 1981. So we're the first institution to basically execute the first FX swap. Just a little color.
Well, thank you both, and thank you both so much for being here. So we'll jump right into our topic. So over the past year, we've seen markets whipsaw with hot inflation and rising interest rates. So what are the challenges that come with navigating a market like this?
Yeah, so I'll jump in on that one, Stefanie. That's a great fact, by the way, too, Attila. I did not realize that on the swaps with World Bank. That's pretty neat. You're absolutely right, Stefanie. It's been a pretty interesting market for sure. We're certainly, volatility seems to be the new norm. I think I'll talk a little bit about our program specifically with the CanHouse program, and I think a few things that make it, I'm not going to say resilient to, because obviously, all issues investors are dealing with it. But I think, the great thing is we sort of had, we've had 20 plus years to build our program out. Our program actually has a financial stability mandate in Canada. So, the purpose is to help with stability in the mortgage market. So essentially the way we're set up to operate is we run a large liquid program that, we pride ourselves on being a very transparent issuer. So, you won't see us as sort of opportunistic as some of the other SSAs. We come to market 8 times a year, so we're fairly scripted. We come, we're usually quite well expected within a few days of when we're going to come. Doesn't mean we've had to make a few tweaks with some of the volatility. We'll sometimes tighten up our launch windows and things like that to make things work a bit better. But, I think that transparency has been very, very helpful for us. And I think too, again, if you look at, I mentioned earlier, the AAA explicit guarantee of the Government of Canada, on our program, is obviously very attractive to investors, right? In times of volatility, this really is a great a flight to quality asset for investors. So I think we're obviously well positioned during times of volatility, with our issuance strategy, with the level of secondary liquidity our program provides, and just the strength of the Canada name, I would say generally, and our guarantee specifically to be able to weather the storm quite well.
And does that issuance strategy change at all during this time?
Yeah, it's a good question, Stephanie. So I'll say typically we try not to. So again, in normal times, and this year is no different than what we consider normally a normal time. We have an issuance cap of $40 billion a year. Canadian dollars. We only issue Canadian. We typically come in right about bang on that $40 billion level. The times we will veer away from that a little bit, and we've done it twice now. Once was back during the GFC in 2009, and we did it also again back in March of 2020, where the Minister of Finance in Canada increased our limits, our cap. So in the case of 2020, increased us to by 20 billion. So we went from 40 billion to 60 billion. And that happened very early days of COVID. So that was, I think that announcement was made like March 20th. Obviously, none of us knew what was going to happen. The world felt pretty shaky. Those first few weeks for sure, and even the first couple of months. I think it was a great recognition of our program that one of the earliest decisions that the Feds made in Canada was to give us increased limit, because we do have a proven track record of being able to go to market even during very difficult periods, very volatile times, and attract strong investor demand. So when both times we did this in 2009 and in 2020, we altered our issuance a little bit in that we issued a 3-year bond, which we don't normally do. So normally we do 5s and 10s. We issued a 3-year bond, which which is fairly strategic, as we're able to tap a lot of official institution and bank treasury demand in that tenor. So folks that would normally buy that in the secondary market, we'll offer it up on primary. And our first issuance we did following that announcement in March of 2020, we did a $6 billion 3-year trade. So that was a pretty good sized trade, and I think it was one of the bigger trades that got done in 2020 globally. So obviously quite proud of that. And again, I think the support of the government, seeing this as a systemically important program is quite important.
Oh, really interesting. And Attila, for you and your role at the World Bank, what challenges are you navigating at this point?
Well, we are full of challenges, obviously, but let me highlight 2 things which are basically interconnected with each other. And I can echo a little bit again what Dave mentioned a little bit earlier. Now, one big challenge is the decreased liquidity on the treasury market, and based on this, actually across the fixed income universe. One of the great tools, what I like to check basically almost every day on my Bloomberg screen, is the U.S. government securities liquidity index. And I strongly suggest to check that one as well. Now it's actually positioned at the highest level in more than 11 years. We are almost at the same level as we saw during the beginning of pandemic, right? Which was essentially a one-off moment in the financial markets. But now we are fundamentally creeping to that level, which is quite bad. Obviously, it leads to basically increased volatility across the different asset classes as well. The other thing which is obviously in my mind as an investor and in the mind of our clients who are also obviously real money investors is essentially where the rates are going to go. We're recording this discussion just for caveat the day of the Fed meeting. So it's 11 o'clock. The Fed meeting will be at 2. So we'll get some more information a little bit later. But just put into perspective, as I like numbers and I like history as well. Exactly a year ago, the 2-year Treasury yield was 21 basis points. Now we are around 4%. I mean, that's a very massive increase in terms of the speed and in terms of the order of the magnitude of the increase. Essentially, basically, and a little bit more than 1 basis point increase per day on average during this 1 year. That's a brutal move. And I believe in supply and demand dynamics, and there are very interesting dynamics which are ahead of us in terms of the expectations. So one is the net Treasury supply in 2023 is expected to be $1.5 trillion. Prior COVID, it was around 500 billion. So basically 3 times more. That's one thing. The other thing is that lots of big real money investors, lots of central banks around the world are actually decreasing their exposure to treasuries for different reasons. But let me highlight, for example, Japan, which is actually decreased its exposure and turned into net sellers of U.S. treasuries essentially in this year, because of the funding cost is actually quite significantly increased because of the mismatch of the underlying base rates. And if Japan is going to intervene on the market to basically strengthen the yen, they're presumably going to sell more treasuries on top of the cash what they earn. Also, if you look at China, China decreased the treasury exposure in the first 7 months of this year based on the TIC data by close to $100 billion. Granted, the July number was slightly higher. It's increased by a little bit more than 2 billion, but still it's quite massive decrease. And also, I think what is very interesting and a new phenomena on the market, right, is that the equities cannot be hedged with the fixed income instrument at this stage. So basically a demand from that perspective is also evaporating. So they basically lots of very interesting things, but two major challenges: liquidity or lack of liquidity, and the trend and the increased supply versus decreased demand on the treasury market, which has a very important aspect for all the other fixed income asset classes.
Certainly an interesting point, especially given that the U.S. Federal Reserve has expressed that one of its key concerns is liquidity. So let's look at the flip side of this for a second then. We've gone over the challenges, but what are the opportunities in a market like this? Like, how does an investor take advantage of this situation? Attila, let's go with you first on this one.
All right. I think you see from the perspective of the liquidity, the very interesting opportunity here, if we just look on the micro level, is the increase of the relative value trade opportunities. As there's a mispricing is getting bigger and bigger, the opportunity set is actually increasing. So I clearly believe that there are lots of opportunities on the market, lots of duration neutral opportunities on the market, which basically helps overcome these liquidities. But obviously it will have a cost associated to it, especially basically the implied liquidity. The other interesting things which we see emerging, that there are more and more issuers are actually issuing callable securities, which I think a very good tool to use in portfolios, especially short duration portfolios. As the volatility increased, the cost of essentially optionality also increased, and it gives an additional spread and additional opportunity for the investors. These two what I would like to highlight at this stage.
And Dave, from your perspective, what are those opportunities here?
Yeah, no, it's a great question, Stefanie. I think, and Attila, I agree with absolutely everything you said. From our perspective, I think, we're seeing that, we're seeing certain certain investor types absolutely see the RV here. Our bonds, like everyone else's have, we have obviously seen some spread widening in this environment. And I think, there certainly are a number of investors that are happy to take advantage of that, right? And, we look, as recently as, last week, we did a 5-year fixed rate transaction. We printed a $5 billion deal, but books were in excess of $6 billion. So, again, a tricky backdrop last week when we launched that trade. And, I wouldn't say it was a great market, but nonetheless, we still ended up 20% oversubscribed, which was, I think, a pretty good result. And I think maybe the thing and this ties a little bit of what you mentioned earlier too, Attila, is I think we're seeing the composition of our books change a little bit. Your comment about certain, maybe Asian investors not being as active because of the hedging costs and like, I would say we're starting to see some of that filter through with ours too. So, we're typically, our program, I would say we consistently see about a third of our program, 30 to 33% of our program on primary goes international. We have seen those numbers dip a little bit on the last few trades, but I am happy to see that, our overall books are still remain very, very strong. So although we are seeing internationals fall away a little bit, we are seeing the broader domestic investment still very, very strong. So I think that's, I think that's good, and I think we continue to be able to operate well in these difficult times. Maybe if I flip to the liquidity piece for a sec, that's I think something with our program that's it's a little bit unique. The way we run our syndicate, it's a little different than what you sort of your typical sort of pot style, SSA syndicates. We do pay full selling underwriting fees on all our issues. So, we've got 11 banks in our global syndicate. We push them very, very hard on secondary market making. So, one of my key syndicate management tools is secondary trading and market making. So, we see that as very important. And in particular during times of volatility, we focus extremely hard on that with our dealers. So, if we went back to, we were pulling some stats on this, and we went back to 2020, and we saw one of our highest months of all time for secondary trading in March of 2020, which seems a little bit unlikely given the amount of volatility we saw back then. But I think it's a good testament to the fact that our investors know they can buy and sell these positions very, very easily because they've got a motivated syndicate that's willing to make good two-way markets in our bonds.
It's such a fascinating time and such an interesting discussion, and we never have enough time to really dive into these well. We've got about 2 minutes left in the panel. So to wrap up, I'd love to hear from each of you what you're looking for over the next 6 to 12 months. What are the red flags you're watching for, and what are the opportunities or the signals that things could be starting to ease a bit? So Attila, let's go with you.
All right, it's an excellent question, and there's a lot of things we try to monitor very closely, but obviously very hard to pinpoint exactly the warning signals. I mean, obviously, beside the fundamentals, that's very clear, and also on top of what the official communication is coming from the Fed, these are obviously the main red flags for us. I tend to follow very closely the liquidity indices. That's for me key. I try to follow the tick indices to see the Treasury data in terms of the international flow. I think very interesting to see the basis swap movements as well. It shows distress in the market if there is any, and again we see some actually increase over there. And also obviously as a real money investor, and we talked about it a little bit earlier as well, the reserves composition of the main real money investors. Look. Even though I think the US is going to come out from the current situation faster and stronger, we see some very significant issues, especially in Europe, for example. The winter in Europe might be very, very challenging, and there are multiple of emerging market countries which are already depleting their reserves. So there are multiple landmines surrounding us.
And David, for you, what are you keeping an eye on? What are you watching for?
I would say everything that Attila's worried about for sure. Maybe with a little bit of a Canadian, obviously a little bit of a Canadian lens on it. We'll continue to obviously watch how effective the bank hikes have been, Bank of Canada. I think we saw some encouraging data yesterday on the inflation front with the print that was finally coming in a bit lower, which is great. So it seems like hopefully the cuts are starting to work as intended. So we'll obviously continue to watch that. I think, personally, when obviously the Fed will be watching closely too, but, I think Attila's comments around Europe and, just the unfolding energy crisis over there, I think is, obviously is quite concerning, along with, other macro events out there.